All right. In this video, I'm going to talk about foreign exchange rates. Specifically, I want to cover two concepts. One is the spot rate, and the other is the forward rate. So let's start with the simplest of the two, which is the spot rate. The spot rate simply means if I want to buy a currency now, I will pay the market price. So let's give a simple example. I want to buy 1,000 euros and I want to use US dollars. So what is the spot rate? The spot rate, how many US dollars do I need to purchase the 1,000 euros? For immediate delivery. That's the key concept, immediate delivery at the market price. So that's the spot rate. Now let's move to the future rate. The future rate is the value of a currency pair in the future. So obviously you would ask, how can this be? How can we know the price of one currency against the other in the future? Well, I'll get to that in a minute. But why would we even think about forward rates? Because parties, in order to hedge risk, and we'll talk about this in a little bit of detail in a minute, want to lock in the future price of one currency against another. And they do this mainly by a currency forward contract. So, currency forward contract, it's a contract between two parties in the foreign exchange market that locks in the price of the purchase or sale of a currency on a future date. All right, there's a little what we need to know. How do we get from the spot rate to the forward rate? Well, there's a way to do it. We don't have a crystal ball to know exactly what these future prices will be, but remember, when the parties enter into the forward contract, they're taking on obligations to deliver these currencies according to the terms of the contract that they entered into. So let's look at this hypothetical I've given. The spot rate is one US dollar 40 cents for a euro. That's a spot rate. So if I want one euro, I need $1.40. Now, what's the formula that professionals use in order to determine this future rate? Well, if you look at the slide, so we take the forward rate divided by the spot rate. Of course, we don't know it yet. We're going to use a little bit of algebra. Equals 1 plus the interest rate of the price currency divided by 1 plus the interest rate of the base currency. So what are the main assumptions? The assumption is that we know the interest rate on each of these currencies. Also, what has to be clarified is that if we're going to use dollars to purchase euros, then dollars are the price currency and the euro is the base currency. Why? Because I'm going to use my US dollars to buy euro. All right, let's make some further assumptions. So we assume the interest rate for the dollar is 10%, the interest rate for the euro is 55%. And now what we're going to do, we're going to begin to plug in these numbers according to the formula that we saw in the preceding slide in order to determine what is the forward rate. So it's 1 plus the 10% divided by 1 plus the 5% times the spot. What have we done? We've just done a little bit of algebra to get rid of, so we can get to the forward rate. So what is the forward rate? The forward rate, under these particular assumptions, is $1.47. And let's assume that it's we're out a period of 1 year or out a period of 6 months. So what is the key for determining these future prices? Well, it's the interest rate on each currency, which is called interest rate parity. But let's use a hypothetical that simulates a real-world transaction. So let's move forward to not that one. No, I want to go to this one. Okay. So why would parties use currency forward contracts? It's to mitigate, or at least to manage, risk of the future volatility of the two currencies involved. So an excellent example is exporters and importers. And I took the example that you can see in the slide directly from a publication of the Central Bank of New Zealand. So we have an exporter in New Zealand, and we have an importer. It could be any other place. And the contract, the import-export contract, it's priced in dollars, US dollars. It's not priced in New Zealand dollars. So at the time the contract is entered into between the two parties, the New Zealand party and the non-New Zealand party, the price is 100,000 US dollars. So let's look at the spot rate. So if the spot rate is 1 New Zealand dollar is worth 65 US cents, the contract from the perspective of the exporter, the New Zealand party, is worth 153,850 New Zealand dollars. That is the amount that at the spot rate that this exporter could get if it were paid 100,000 US dollars. And of course, the exporter would like to receive a similar amount in the future when the goods will be delivered and the payment will actually be made. But he's not going to know what is the currency pair exchange rate at the future date. So let's just assume, so we can show how these currency forward contracts work, that 6 months out, the New Zealand dollar now is worth 68 US cents. So what's happened? The New Zealand dollar has appreciated against the US dollar, meaning that the exporter will get less New Zealand dollars if the dollars are converted at this particular exchange rate. So what would he get? 147,000 instead of the 153 that he anticipated. Why is this important to the exporter? Because the exporter has payment obligations in New Zealand dollars, not necessarily in US dollars. All right, so what can he do? The New Zealand exporter can enter into a currency forward contract in order to hedge the risk. And what do I mean by that? This exporter will go to its local bank in New Zealand, explain what it wants to do, and will lock in a future price of New Zealand dollars against US dollars, so that the spot and the forward rate differ by very little. And if it's possible, even to have the forward rate equal the spot rate. Now, this is going to cost the New Zealand exporter money, has to pay for the currency forward contract, any commissions or fees, but the bank will arrange it through the foreign exchange market. There's always counterparties that will take on the risk of currencies appreciating or depreciating against one another. Yes, as I said, the key to understanding these differences is that we use interest rates on different currencies. So, how do you gain and lose? Well, from the perspective of the exporter, it will know exactly how many New Zealand dollars it will get when it's paid $100,000. So it gets security. It wipes out the risk of an adverse movement in the exchange rate between the New Zealand dollar and the US dollar. But he may actually lose. If the New Zealand dollar appreciates against the foreign currency, the foreign currency, the exporter wins. Okay, it's great. Then he's going to get this this better exchange rate. But what if the New Zealand dollar depreciates? Well, then the exporter, in a sense, loses, because if he did nothing, if he didn't enter this into this currency forward contract, he would have gotten more New Zealand dollars when he was paid the 100,000. But what's the trade-off? The trade-off is one, it's certainty, locking in a specific exchange rate so you know in the future what you're going to be paid, allows you to manage your business risks in a organized manner. And if the exporter adopts a policy of using currency forward contracts in most of its transactions, these gains and losses are going to even out. One thing I didn't mention is that there is an alternative. The exporter could use exchange option contracts. And as we have discussed in exchange option contracts, there is no obligation to exercise the right if it isn't going to benefit you. You could just let it lapse. A currency forward contract, no. This is done in the OTC market, as I've explained. It's customizable and both parties must perform. So why would an exporter, like the one we have in New Zealand, select the currency forward contract over the exchange option? Well, the simple answer is that the currency forward contract is probably, if it's going to be used in the business, it will be less expensive than using exchange options. So I wanted to make this short video because one of the prototypes that I have listed as a possible issue for research deals with spot rates and forward rates. So this gives you a very basic, superficial overview of how they are calculated, what's the difference, why would you use a currency forward contract, but I expect if you select an issue like this that you're going to go into it on a much deeper level. Thank you, and if you have any questions, please ask me.